They did not ring a bell. They did not hold a press conference. They did not put a warning label on your screen. It just happened in the background, quietly, the way the biggest moves always happen. If you opened your phone today and you saw silver surge, then snap back, then surge again, and you felt that familiar confusion, like the market is speaking in a language you do not understand, pause for a second. Because this is not random. This is not retail excitement. This is not a meme week. What you are watching is the first shockwave of a demand story that is bigger than the trading day, bigger than the chart, and bigger than most people are prepared for. And the reason it is happening now, the reason it is showing up as violent price action, is because two names just pulled a lever that almost nobody connects to silver until it is too late. Microsoft, BlackRock. I am not saying they woke up and decided to buy bars of silver. That is not how this works. The silver bomb is not a single buy order. It is a chain reaction. It is capital spending that forces procurement. It is infrastructure that forces supply chains. It is a build-out that forces metal, whether the market likes it or not. And here's the part that matters. This demand does not care if silver is up or down on a screen. It cares about delivery dates. It cares about contracts. It cares about keeping systems running that cannot afford downtime. So if you are only staring at spot, you are going to miss the real signal. The signal is not the candle. The signal is the pressure underneath it. Let me frame the battlefield, because once you see it, you cannot unsee it. There is a price level in every market where traders start acting like it is a ceiling. They sell it, they short it. They tell themselves the same story they have told for years, that silver always pops and fades, that silver always teases and retreats, that silver is the asset that cannot hold a breakout. Now imagine that ceiling is real for the paper market, but it is meaningless to the people who actually need the metal. That is where we are. And that is why this is dangerous for the shorts. In this investigation, I am going to do three things. I am going to show you what the silver bomb actually is in plain language. I'm going to walk you through the playbook the market uses to smother silver spikes and why that playbook breaks when demand is industrial and non-negotiable. And then I am going to show you the tell, the one behavior that separates a normal rally from a squeeze setup. So what is the bomb? Start with Microsoft, because Microsoft is not a software company in the way most people think. It is cloud, data centers, and AI compute. And AI compute is not a magic trick. It is electricity, hardware, cooling, power distribution, networking, and a constant appetite for components that conduct, connect, and survive heat. When you scale compute, you scale everything behind compute. You scale switchgear, you scale relays, you scale connectors, you scale power conversion, you scale redundancy. And redundancy is where hidden materials stack up, because the whole design goal is to never fail. Silver sits inside that reality in 100 small ways. Contacts, switches, solders, high reliability connectors, coatings, specialized pastes, the unsexy parts that make the machine work. Now bring in BlackRock. BlackRock is a funnel for capital into real-world projects. When it pushes money into infrastructure, it does not buy a dream. It finances the build. It accelerates grids, facilities, and the supply chains that feed them. And that kind of financing does not create a silver headline. It creates an order book. Here's what most people miss. When large operators commit to new capacity, procurement teams do not wait for the metal price to be convenient. They secure inputs, they lock vendors, they reserve production slots, they hedge risk, they buy certainty. That is the demand shock. It is not a crowd chasing a candle. It is a system quietly shifting from just in time to just in case. And that shift is brutal for silver because silver is not a giant market. It does not take a miracle to tighten it. It takes a few big, steady buyers with deadlines. Now, you might be thinking, we have heard the industrial demand story before. Solar, electrification, everything. And yet silver still gets smacked down. It still does the same annoying thing. Exactly. That is why this moment matters, because the market has muscle memory. The market is trained to fade silver strength. So when a new demand engine shows up, the first reaction is not to believe it. The first reaction is to sell into it. That is how traps are built. Let me show you the two worlds sitting on top of each other in silver, because this is where people get fooled. World one is the paper world. Futures, options, leveraged positions, algorithms reacting to levels, funds that do not want delivery. In that world, silver is a number and a trade. World two is the physical world. fabricators, manufacturers, refiners, mints, industrial buyers. In that world, silver is not a ticker. It is a material with lead times, premiums, and constraints. Most of the time, World 1 dominates price. That is why silver can feel like a game. Huge volume, little progress. The screen moves, then it gets pinned, then it goes sideways, and everyone shrugs. But when World 2 starts pulling hard, World 1 starts losing control. And when World 1 loses control, you get gaps, stress, and moves that feel sudden and unfair. This is where the Microsoft and BlackRock story turns from a headline into a weapon, because the paper market can play games with sentiment, timing, even rules. It cannot play games with a factory schedule. Now let us talk about the suppression playbook, because if you do not understand it, you will misread what comes next. When silver gets too hot, the system usually does one of three things. It shakes the tree, it dumps paper into thin liquidity, runs stops, and creates a fast drop designed to scare you out of the breakout. It tightens the leash through margin and collateral, not because demand vanished, but because leverage gets squeezed, forcing selling from the most fragile hands. Then it changes the narrative. It floods the space with reasons why the move is over, why demand is exaggerated, why supply is coming. That combination has worked for years because traders are conditioned to it. And I want to slow down on the margin part because this is the kill switch most people do not notice until it is pulled. A futures contract lets you control a large amount of silver with a relatively small deposit. That is the point. It is why the market can move so fast. It is also why it can be slammed so fast. For example, one standard contract represents thousands of ounces. You are not paying for all of it up front. You are posting a performance bond, a chunk of cash, a margin requirement. When the margin requirement is low, funds can take big positions with limited capital. When the margin requirement jumps, the same fund suddenly needs a lot more cash right now, or it has to cut positions. So imagine a large trader holding hundreds or thousands of contracts. A margin increase does not feel like a small policy change. It feels like a surprise invoice. Wire more money or sell? That forced selling looks like panic on the chart, but it is not always a change of belief. It is a change of rules. Now here's the twist. That playbook only works when the move is driven by speculators. If the move is driven by real buyers, the playbook becomes a discount machine. Every engineered dip becomes a buying opportunity for the people who actually need metal. That is why you can see a violent drop and then a stubborn bid. Sellers show up, and the market refuses to stay down. This is also why some of the biggest silver moves in history began with a smash. The smash is meant to end the story. Sometimes it starts the next chapter. Now bring in timing, because timing is the fingerprint of intent. You get a breakout attempt, then you get pushback, often when liquidity is thin, often when the most people are not watching closely. Then you get the retest. The level everyone thinks should fail gets tested again. If that retest holds, the game changes, because it tells you demand is not just chasing, demand is defending. So where are we? We are at the moment where the market is trying to decide if this is a story or a structural shift. You can see it in how silver responds to dips. Not just the bounce, but the speed. Not just the price, but the refusal. A retail-driven rally fades when retail runs out of breath. An industrial-driven move pauses to reload. And those two names, Microsoft and BlackRock, represent something specific. Scale and financing that does not blink. Multi-year commitments, not a weekend trend. When the build accelerates, demand does not arrive politely. It arrives as orders. And those orders show up in the real world first. Longer lead times, buyers paying up for certainty, vendors telling clients to book earlier, forms and products that suddenly feel tight even if the screen price is calm. That is how physical stress sneaks up on the paper market. The paper market lives in the now. The physical market lives in the next quarter. So the chart can look normal while the pipeline is filling. Then one day the price tries to pop, and instead of fading, it sticks. And the people who have been shorting every pop suddenly realize they are not fading a pump. They are fading a shortage. That is when the scramble begins. Now let me name the trap clearly. The trap is the fake breakdown. The spike, the slam, the chorus that says, there it is, same old silver, back to sleep. And then the market stabilizes. It holds the line. It starts grinding back. That grind is boring. It is also deadly. Shorts need panic. Shorts need momentum down. When the market refuses to break, the short thesis decays every hour. And this is where you have to stop watching silver like a spectator and start watching it like a detective. When a smash happens, ask a simple question. Who is actually selling, and who is quietly buying the fear? Because in a normal blow-off move, the dip is empty. Volume disappears, bids pull back. Everyone waits for lower prices. But in a real accumulation phase, you see the opposite. The hit lands and the market gets busy, transactions pick up, the drop meets immediate demand. It looks messy, but it is not weak. If you have ever watched tape during one of these moments, you know what I mean. The market can print red candles while the buying is real because the buyers are not chasing. They are absorbing. They let the sell orders come to them and they take them. That is why a move can feel violent without actually breaking structure. The price flinches, then it stabilizes. It stops leaking. It starts finding a base. That is not what exhaustion looks like. That is what digestion looks like. And when digestion is happening, it usually means the next attempt higher has a better chance of sticking, because the weak sellers already spent their ammunition. And this is the psychological warfare part. Silver does not need to go straight up to hurt shorts. It just needs to stop going down. Now let me give you the midpoint recap, because some of you are listening while driving, or you jumped in late. The core claim is simple. A large infrastructure wave is accelerating. Not just any wave, the kind that is measured in power, facilities, and hardware. Microsoft symbolizes the demand side of that wave, the compute build. BlackRock symbolizes the financing side, the capital that makes projects move faster. Silver sits quietly inside the components that make this wave possible. The paper market is positioned to fade silver as it always does. The physical side is positioned to secure supply. That collision creates stress, and stress is what can flip a normal rally into a squeeze. Now, there is a second layer that makes this even more explosive, and it is about speed. Silver demand is not just about total annual usage, it is about timing. A market can handle steady demand. It struggles with demand that shows up early and all at once. When procurement teams decide they cannot risk shortages, they pull orders forward. They buy earlier. They double order. They build buffers. They do all the things that make sense for them and feel like a shock to the commodity. This is why a demand cycle can feel sudden. It is not that the world changed overnight. It is that purchasing behavior did. Now, why does that matter for silver in particular? Because silver has a reputation. It is seen as volatile, as unreliable, as the metal that burns traders. That reputation discourages long-term positioning in the paper market. It encourages shorting spikes. It encourages the belief that you can always sell into strength and buy it back later. When demand shifts, that reputation becomes a trap for the people using it as a strategy. They keep shorting strength. They keep expecting the fade. They keep leaning on the ceiling. And then one day the ceiling does not hold. Now you may be asking, what does the market do when it feels the ceiling is failing? It gets more aggressive with the tools it controls. It uses margin, it uses rules, it uses surprise hits in thin liquidity. It tries to make the chart ugly, but those tools do not fix supply constraints. They just transfer pain. A margin hike might force a leveraged fund to sell. It does not stop an industrial buyer from needing parts. It does not stop a manufacturer from placing an order. It does not stop a build-out schedule. So if the underlying pressure is real, rule-based pressure becomes a lid on a pot. It can hold for a while. It can also make the release worse. Now we are back to the question that matters. The question is not, can they smack it down? They can always smack it down. The question is, can they keep it down? And that is answered by one thing. Does buying show up after the hit? You cannot see every private contract, but you can see footprints. You can see the way silver behaves after the attempt to break it. You can see whether dips crack through the floor or whether they get absorbed. If this was paper hype, the dip becomes a waterfall. If this is a demand shock, the dip is where real buyers step in, quietly, aggressively, and the chart starts acting strange. Now comes the part that separates a normal rally from a system problem. When paper tries to cap price, but physical keeps pulling, you get a growing spread between what the screen says and what it costs to source metal. The screen price becomes less believable to the people who need the commodity. They start planning around availability, not around the quote. And once enough real buyers stop trusting the screen, price discovery breaks. Not in theory, in practice. You see it as persistent tightness and persistent bids that do not vanish on red candles. This is why people who understand commodities watch behavior more than headlines. They watch what happens after the smackdown. They watch if the market can stay weak. Because in a healthy suppression cycle, weakness sticks. In a real demand shock, weakness gets bought. This is also why the weekend matters. Thin windows create big moves. Late Friday, Sunday night, the Asia Open. A small push can print a scary chart and shake out confidence. If the system wants to contain silver, it will try to do it in those windows. It will try to force a drop when fewer people can respond. But if demand is real, those windows become opportunities too. Buyers with budgets, deadlines, and no patience for theatrics. So over the next few sessions, watch the timing, watch the floor zone where dips keep getting caught, watch the speed of recoveries after smackdowns, and watch whether the build-out story keeps getting confirmed in the boring places: power, capacity, facilities, financing. Because if the demand shock is real, the market will not forget it over a weekend. It will come back to it. This is usually how the next sequence unfolds when the move is real. You get the initial pop, you get the attempt to kill it, you get the narrative that it is over, then you get the grind as dips are bought, then you get the moment where shorts realize the exit is a narrow door and everyone is trying to leave at once. That is the squeeze dynamic. Now, I am not going to pretend I can tell you the exact day this erupts. Markets are not that polite. Silver can chop, frustrate, and punish both sides. What I can tell you is that the setup changes when demand is non-negotiable, and AI infrastructure and power infrastructure are becoming non-negotiable, not because of hype, but because every major company is in a race for compute and resilience. That race is funded, it is scheduled, and it touches materials. So I will end with the point that matters most. Silver is a bridge between finance and reality. If the world is truly building AI and power infrastructure at scale, then silver demand is not a preference. It is a necessity. And if that is true, the old habit that every silver rally is meant to be sold becomes a dangerous habit. Do not let volatility hypnotize you. Volatility is what happens when two worlds are fighting. Paper trying to contain, physical trying to source. If you see dips that refuse to break. If you see repeated attempts to push silver down that fail to change the trend. If you see recoveries that happen faster than they should, then you are not watching a normal rally. You are watching pressure build. And pressure does one thing in the end. It releases. The silver bomb is not a single moment. It is a process. Capital turning into projects, projects turning into orders, orders turning into material stress. So keep your emotions out of it. Watch how the market reacts after the hit, not what it prints in the panic minute. Because if Microsoft and BlackRock are helping accelerate this infrastructure wave the way it looks like they are, then the demand shock no one saw coming is not coming. It is already here.